I think I might have found another extremely undervalued company and stock. When I say extremely undervalued, meaning that it's priced as if it's not going to grow at all. And yet, as you can see right here, the analyst estimates, it expects this company to grow 6% in fiscal year 2024, 7% in fiscal year 2025, and 6.8% in fiscal year 2026 when it comes to sales, so top line. Bottom line, it expects to grow around 21% year-over-year growth in each of those years. And yet, based on a reverse DCF, it's priced as if it's going to grow 0%. Now, this company is called Expedia. So yes, it is in the travel industry, which of course has a little bit more risk to it. It's not a PayPal type of stock or something else. It's travel related. So there's always a little bit of risk there, some cyclicalities, and we know from Expedia, from Booking, from Airbnb that they're seeing some weakness in the travel sector. But still, as you will see throughout this video, I think it's still quite cheap. Year to date, the stock is basically flat-ish. It's down 1.7%. Yes, it's true that in the last month it's up 8.7%, and the last 3 months it's up 17%, has a market cap of $19.41 billion and a forward PE of 11.8 times. Definitely not the expensive stock out there. And so, before we continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if not. We're on our way to reach 60,000 subscribers by the end of the year. So if you're new here, do me a favor and hit that subscribe button. It's free. You can always unsubscribe once we reach these huge milestones. Thank you very much. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, Expedia, it operates as an online travel company in the United States and internationally. The company operates through 3 segments: retail, business to business, and Trivago. You've probably heard the commercial already. Hotel, Trivago. Its brand portfolio includes well-known names such as Expedia, Hotels.com, Vrbo, Orbit, Travelocity, and more. Now, this is basically the profile of the business: gross profit margin of 88.9%, EBITDA margin of 13.39%, operating margin of 11.97%, with a net profit margin of just 6%, EPS diluted $5.66, operating cash flow per share $19.34, free cash flow per share of $14.02, return on total capital 10.76 return on capital employed 17.27 and a forward PE of 11.77 and a PE ratio right now, basically in the last 12 months, 26.37. Now, last quarter, these were basically the comments and numbers. So 10% growth in room nights, 6% growth in gross bookings and revenue, driven by improvements in Vrbo and strength in brand Expedia, advertising, and the business-to-business segment. Acceleration in traffic growth, conversion rates improvements, and growth in multi-item trips. Vrbo improved from Q1 lows, and the One Key loyalty program is driving new customers to Vrbo. They saw continued strong growth at over 20% with expansion in supply partnerships like Ryanair when it comes to the business-to-business business, B2B business. Now, as for the outlook, they see a more challenging macro environment and slowdown in travel demand entering Q3, leading to a revised outlook, which we're going to talk in just a second. The focus right now is driving efficiencies across the P&L through cost discipline while investing in marketing for Vrbo and international expansion. So, as for the outlook, we expect third quarter gross booking and revenue growth to be in the range of 3 to 5% versus last year, and as a result of the range of possible top-line growth and marketing investments in Vrbo and our international markets, we expect approximately 100 basis points of deleverage to our third quarter EBITDA and EBIT margins versus last year. As for the full year, we expect gross booking to be at the low end of our previously communicated range of mid to high single digits at approximately 4%, and revenue growth to be 2 points higher at approximately 6%, with our earnings outlook holding at EBITDA and EBIT margins relatively in line with last year. Now, if you wanted the major overview of the quarter, not just what I read, you can pause the screen and look at all those numbers. You can also see here free cash flow has increased 42% year over year. Now, how does it compare to Airbnb and Booking? Well, we can see it right here, forward PE, price earnings to growth, price to free cash flow, and EV to EBITDA. We can see that on all of those four metrics, Expedia is much lower. Airbnb is the most expensive when looking at forward PE. Price earnings to growth sits at 1.86, Booking at 1.29, and Expedia at 0.69. If you look at price to free cash flow, Booking sits at 19.1, Airbnb 18.7, and Expedia at 9.7 times. All three are not that expensive based on that metric. On a forward PE, you would say that, yeah, Airbnb is a bit expensive right now. Again, it's because of the weakness that's expected to happen in the coming quarters. But all of them are very, very good free cash flow generating businesses. If you look at EV to EBITDA, Airbnb sits at 18 times, Booking 17.7 times, and Expedia 6.9 times. Now, you can clearly see the pattern here. You can clearly see that Expedia is much, much lower than both of the other businesses. Now, of course, there might be a reason to that. There might be a reason why Expedia does not get the premium than the other two. The other two are tremendous businesses. I personally own Airbnb. I'm sure some of you own Booking as well. Tremendous business. With Expedia, this is basically the story right now. It's a story of show us what you got, show us that you can improve your business. Because they did some acquisitions, they did try some new things, didn't work out or did not work out just yet. We are seeing some small improvements. Now let's see what happens. And as you can see right here, revenue growth, of course, exploded back here in 2021. But then we saw decelerating growth quarter after quarter after quarter. Now revenue continued to grow, but of course not as fast as before. And free cash flow has come down, but it seems like it did bottom here in Q1 of 2024. These are last 12 months figures. But as I said at the start of this video, this is a company that is buying back extreme amount of its own shares. Since Q4 2021, shares outstanding have come down close to 16%. Let me repeat that. In the last 3.5 years, shares outstanding are down 16%. That's incredible. Of course, that's also boosting your EPS, but still, I mean, okay, if the stock was cheap, they're generating cash, I mean, why not? Why not buy as much shares as possible? Makes sense. Now, if we're looking at this reverse DCF, you can look at this right here. So the current share price, $149. Free cash flow trailing 12 months, it's around $2 billion. I put here this exact number, $1.926 billion. Terminal growth rate of just 2% and a discount rate that is higher than what I would put. I would usually put here 9-10% or so, but I went even further. I put here 11%. And look at this. The estimated intrinsic value with all of this, with an implied growth rate of 0%, we're sitting at $146.18. This makes 0 sense, right? It's incredible. I mean, let's change it up. Let's do 10% right here. If we're doing terminal growth rate of 2% with a discount rate of 10%, with an implied growth rate for the next 10 years of 0%, the estimated intrinsic value sits 8.9% higher than the price we're at today. It's crazy, no? I understand that the travel industry, I understand that we don't know, we cannot be sure of what will happen in the future, right? But still, I mean, is there not a huge margin of safety here? Let's say we've seen the growth numbers or the expected growth numbers. Let's say again, it only does, that's 8% or so. Only 8%. I mean, only. It's 8%, still a decent number, meaning the stock right now could see 48.8% upside based on what we put right here. Let's be even more conservative. I just show you what happens with 0%, but let's just 5%. 5% implied growth rate. That's 36.3% upside. And in my opinion, we're still being very, very conservative here because the terminal growth rate could have easily been 3% or so, 2.5%, which will definitely make this even higher. So yeah, Am I missing something here, or is this yet another great opportunity? We've seen it with PayPal as well, right? PayPal back at, what was it, under $60 or so, was basically the same thing. 0% growth priced in. 0% for a company that is buying back a lot of shares and is actually growing. Now, like I said, this is not a PayPal, this is a different industry, and risk profile is also different as well. But come on, still, again, I might be missing something, but I don't think I am. And even if I'm missing a little bit, there is still a margin of safety here that if my miss is, let's say, 1%, 2%, I mean, we still have something to play here with, right? We even put 2% implied growth rate. 2%, the upside is still 21%, which is still quite good. So, yeah, when I saw this, I was like, this is interesting. This is very interesting. So, yeah, do share your thoughts down in the comment section below if I'm completely nuts here or if I actually have something on my hands. Right now, if you look at the stock, it did make a little comeback here after the previous earnings report here back in April. Numbers weren't that great as you've seen in Q1, not that great, but since Q2 showed that Q1 might have been the bottom, the stock went back up. We've had here a double bottom at around $110 or so. Plus, I mean, they were buying back quite a lot of shares. I think the share buyback program was around $3 billion and the market cap was $15 billion. So, I mean, you can do the math. That's a lot of shares that you can retire. And now we've made our way back up here, which was previous resistance at around $150, $155. But previously, this was a stage where it was overbought. Right now, we're not there yet. So it remains to be seen. But yeah, overall, I did want to share this. If I'm completely wrong, do let me know down in the comment section below. And if I'm right, do the same thing. And then like, subscribe, do all of that. And I'll see you all in the next one. Bye-bye.